Hi, in case you're wondering what's going on with the recent economic recession triggered by the oil war and the COVID-19 crisis in year 2020, welcome to today's video. If you have not met me, my name is Chris Chan. Before I retired a few years ago to mentor leaders, advisors and investors at the regional conferences and financial institutions, I was managing a top wealth consulting group that I founded with over 80 partners and associates. Having spent more than 20 years in the financial market both as a wealth consultant as well as an investor has taught me many precious life lessons when it comes to money and success. Now, there's no doubt we are in the midst of probably one of the world's worst crises since the Great Depression in 1929. With my personal experience in the Asian financial crisis in 1998 as well as the 2008 global recession, I prepared a series of simple to understand videos backed by extensive research on what led to this crisis, what's happening right now, and what are the strategies that you can use to survive and thrive above this financial tsunami. So first up, let's define what exactly a recession is. As a whole, a recession is a period of economic decline. Now, it is usually accompanied by a drop in the global stock markets, the increase in unemployment rate, a decline in demand for goods and services, a drop in valuation across many asset classes, including the property market. And here is the most important question. What exactly happens during a recession? So first of all, gross domestic product, or GDP in short, falls. GDP represents the economic activity of a country, which impacts almost everyone and every entity in it. When GDP growth is strong, firms tend to invest in R&D, business growth, they hire people with higher salary, and which in turn leads to more consumption in goods and services. So when GDP falls, companies will tend to cut back on their expenditures in an attempt to survive. And we're already seeing that right now around us. Companies that run into cash flow problems collapse, and those who survive are more likely to exercise corporate cutbacks, including layoffs. People who are still employed, they watch their colleagues, their families and friends around them getting laid off one by one. And eventually, it causes them to have the anxiety whether they will be next on the list to be axed. And with that in mind, naturally, you are less likely to spend as well. So you can see the ripple effect with the downward spiral in the economy. So what the Federal Reserve will usually do is to cut interest rate with an attempt to stimulate growth and encourage spending. At the same time, to rescue the situation and stabilize the economy, governments tend to take on more debt or print more money in an attempt to stabilize the economy. In this case, many countries around the world have already implemented some form of stimulus or resilience packages in the billions and even trillions in the case of US. Now, during a recession, the government will often issue government contracts such as investing in infrastructure to stimulate growth and employment. So bottom line, as an average person on the street, your job is at stake. Your income either freezes or drops. Your stocks, along with most of your other investment assets, your home, even luxury goods like your Chanel and Hermes handbag tend to lose their value. The big question right now is, how long will the recession typically last? The Great Recession back in 2008 lasted 18 months, but that was an exception. Historically, the other 10 recessions since World War II have lasted between 6 to 16 months, which is 10.4 months on an average. If you look at the historical records, the US economy falls and it tends to recover regularly and pretty frequently. The good news is that over the long term, the new high in the stock market will always be higher than the previous highs. The new low in the market will always be higher than the previous lows. We'll discuss that in greater detail in my other videos. Now, let us first look at the difference between a recession and depression. Just from the name itself, we could tell a depression is significantly more severe than a recession. A recession signifies a contraction phase of a business cycle where things slow down for at least 2 quarters. A depression, on the other hand, is a much longer sustained period of economic downturn. In short, 2 key factors that separate a depression apart from a recession are severity of how deep the decline is, duration, how long the decline is. So the Great Recession back in 2008 lasted 18 months and eventually led to the longest 11-year bull run in the US stock market history till the recent downturn. The Great Depression in 1929, on the other hand, the decline in the market lasted for 43 months and it took 25 years for the market to reach the previous peak in October 1929. So from these comparisons, we now understand that the depression is deeper and it lasts longer than a recession, a scenario which you and I would never want to go through. So the next question you need to ask yourself now is this crisis going to be as bad as the Great Recession? Or worse, it leads to a global depression? I would love to hear your comments below. And in my upcoming videos, I will talk about how the market is likely to recover and what are the strategies you can use to take full advantage of it. If you like what my team and I have prepared for you, don't forget to click the subscribe button so that you don't miss out on my upcoming videos, especially on those strategies and tips on how to overcome this crisis. Please share this video with your friends on your social media so that they too can benefit. Look forward to see you in my next video.